You think the global economy is stabilizing and your hard-earned cash is completely safe inside your retirement account, but the harsh reality is that you are quietly being set up as the ultimate exit liquidity for political actors and global elites. Comment your current age and the exact dollar amount you invest every single month right now, because this massive hidden financial mechanism is going to completely reshape your personal wealth. Whether you like it or not, the global stage just witnessed one of the most bizarre cycles of geopolitical backtracking in modern history as deals are announced and scrapped within 24 hours. All over social media, self-proclaimed finance gurus are screaming about political instability, but they ignore the underlying rot in the system. The United States is currently facing an unprecedented $39 trillion debt crisis, where annual interest payments have officially eclipsed the entire military budget. Yet the political focus remains on shifting narratives and expensive vanity projects while your purchasing power continues to evaporate. Before we unlock the massive variables governing this economic circus, let us lay down the core truth you need to hear. If you want to achieve true financial freedom and avoid getting absolutely crushed in these macro shifts, you must stop chasing hyper-hype speculative news cycles and stop trying to time the volatile market, because time in the market always beats timing the market every single time. The smartest financial decision you can make today is to ignore the sensationalized political headlines and commit to a disciplined long-term strategy by automating your wealth accumulation. Instead of gambling on short-term geopolitical shocks, look at real practical wealth-building tools like opening a Roth IRA or a tax-advantaged individual brokerage account and consistently dollar-cost averaging into broad market index funds like VOE, which tracks the top 500 powerhouse corporations, or rock-solid dividend growth exchange traded. Funds like SHD, standard passive investing, works beautifully when you stay disciplined, but you must understand that the exact same mechanism making index investing convenient also forces automated funds to buy into structural shifts. To counter this systematic risk, you need to maximize your personal savings rate by aggressively cutting down your lifestyle inflation. Stop financing a $70,000 luxury vehicle just to look rich on social media, and instead choose to drive a reliable 2006 used car while living in a minimalist, low-cost space until your investments generate real passive cash flow. Building true wealth is not about buying into the latest trillion-dollar hype train, but about consistency, discipline, and holding productive assets for decades. Now let us break down the geopolitical plumbing to understand exactly how the global elite are moving the pieces. When leaders announce multi-billion-dollar deals only to reverse course under pressure from special interest groups, it creates massive volatility that retail investors are never prepared for. The current administration is struggling with a $39 trillion debt ceiling that effectively forces them to chase cheap capital. If interest rates do not fall, the cost of servicing this mountain of debt will literally consume the entire federal budget. This is why they are scrambling to control foreign policy narratives and force central bank cooperation, because their fiscal survival depends on it. But while they play these high-stakes games with international agreements, ordinary citizens are the ones paying the hidden tax of inflation. Every dollar printed to cover these interest payments is a direct withdrawal from your future retirement savings. The mainstream media wants you to focus on the drama in the ballroom and the memes being posted by the executive branch, because when you are distracted by the theater, you are not paying attention to the fact that your financial future is being cannibalized. Is this an isolated incident or an alarming global trend that should make retail investors run for the hills? The answer is a resounding no, because this exact operational playbook has played out multiple times across different nations. Take the historical context of sovereign defaults and currency manipulation, where regimes consistently use foreign policy theater to distract from domestic fiscal insolvency. Whenever you see political leaders obsessing over military hardware or foreign blockades while the national debt is exploding, you can be certain that your currency is being systematically devalued. This dynamic confirms that the institutional perspective on your savings has not changed one bit. What has changed is simply the short-term cash flow requirements of the state, which brings us to the most dangerous part of the equation. Why is the political rhetoric escalating right at this exact moment in time? Because across the ocean and within the Beltway, a historical political drama is unfolding that will dictate the future of your retirement portfolio. The pressure being exerted on the central bank to slash interest rates is not some random political theater. It is a desperate survival tactic for an over-leveraged empire. Now, you might argue that central bank chairs have historically been independent and they might completely ignore these demands to cut rates. That is true in theory, but the historical relationship between a president and a central bank chair is a fluid, brutal battleground that continuously shifts based on political gravity. The critical factor is not the economic philosophy they hold when they walk into the job, but whether their psychological makeup can withstand the non-stop bludgeoning coming from the highest office in the land. To understand what the financial markets are going to face, we must look back at the history of modern central bank chairs and how they responded to intense executive pressure, because this historical baseline gives us a high probability matrix for what happens next. Out of the last 8 chairs, only a handful successfully defended their institutional independence against political capture. Those who guarded the dollar possessed either exceptional macroeconomic competence or an immovable tolerance. For executive stress, those who lacked both were instantly swallowed by the political machine. So where does the current leadership fit into this framework? If they hold the line and refuse to cut rates aggressively, the currency will remain structurally strong and your assets will face short-term pressure. If they buckle under the weight of the political demands and flood the system with cheap money, the dollar will devalue rapidly and your long-term savings will lose massive purchasing power. The ultimate outcome does not depend on their personal economic theories, it depends on how much longer the American debt bomb can tick before it completely destabilizes the domestic banking system. When you connect all these pieces of the macroeconomic puzzle, you realize that political theater will not trigger a permanent solution, because institutional investors see it for what it is, a desperate attempt to manage a $39 trillion catastrophe. But the timing is what should capture your absolute attention. This political chaos is occurring at the exact moment the United States is attempting to politically hijack its own monetary policy to inflate away its monstrous sovereign debt. You have massive political instability while the world's largest economy is preparing to print trillions of new fiat dollars to keep its system alive. These opposing economic forces are trapping your wealth right in the middle of a tight volatile trading range. If you look closely at the charts, you will see that while the broader market looks like it is hitting a wall, the price simply refuses to break lower because massive institutional buy orders are quietly stacking up at the bottom of the range, absorbing every single asset sold by panicked retail traders. Volume is accumulating heavily at these support levels, meaning smart money is quietly accumulating the asset, while the mainstream media distracts you with scary headlines. Unless a massive, unexpected geopolitical event completely shatters the current structural balance, the market is preparing for a major upward breakout, because the long-term reality of a $39 trillion debt problem cannot be solved with political ceremonies. Now that you understand the macro game of the global elite, let's talk about how this applies to your personal life and why you are currently losing the financial war. The global financial system is structurally designed to transfer wealth from the uneducated masses who operate on emotion up to the highly disciplined elite who operate on mathematical systems. When you see headlines about central bank interventions or multi-trillion-dollar debt expansions, your natural instinct is to panic, try to trade the news, or buy into highly speculative assets at the absolute peak of a market cycle. This emotional reactive behavior is exactly why the average retail investor finishes their working career with a microscopic retirement account while wondering why they never achieved true financial freedom. You are being lied to by a massive consumer marketing machine that wants you to spend every single dollar you earn on depreciating liabilities just to maintain a temporary illusion of wealth. You buy luxury vehicles on high-interest credit lines, you rent premium apartments that consume half of your take-home pay, and you subscribe to endless digital services that quietly bleed your capital account dry every single month. You are operating with a microscopic personal savings rate which guarantees that you will remain a corporate slave trading your valuable time for a paycheck for the rest of your productive life. If you want to break out of this trap and build a foundational fortress of wealth that allows you to walk away from the rat race on your own terms, you must completely rewrite your personal financial rules. Stop viewing the stock market as a speculative casino where you try to hit a home run on individual technology stocks and start viewing it as a cold, automated compounding machine that demands absolute discipline and zero emotion. The absolute foundation of real wealth accumulation is your personal savings rate, which is the exact percentage of your income that you keep and convert into productive assets every single month. If you make $5,000 a month and spend $4,800 of it on your lifestyle, you have a miserable 4% savings rate, meaning you are working an entire month just to save $200. To fix this structural flaw, you must aggressively attack your two largest fixed expenses, which are traditionally housing and transportation. Make radical, unconventional choices that society will laugh at, but your bank account will thank you. Drive a reliable older used car from 2006 that is completely paid for in cash with zero auto loans draining your cash flow every month. Live in a simple, functional, minimalist space with zero luxury amenities so that you can widen the gap between what you earn and what you spend. Once you have engineered a massive savings rate, you must automate your investment strategy using highly efficient, low-cost index tracking tools. Stop trying to guess when the market will hit a bottom or when the economy will turn, because decades of empirical financial data prove conclusively that time in the market always beats trying to time the market. The human brain is emotionally unsuited for market timing because greed will make you buy at the top of a hype cycle and fear will force you to sell at the absolute bottom of a panic. The structural antidote to this human flaw is dollar cost averaging, which is the unwavering practice of investing a fixed dollar amount into broad index funds at regular calendar intervals, regardless of whether the market is screaming higher or collapsing lower. When you dollar cost average, you automatically acquire fewer shares when prices are high and significantly more shares when prices are low, effectively turning market volatility into your greatest long-term wealth builder. Utilize tax-advantaged accounts like a Roth IRA to ensure that your capital compounding machine grows completely tax-free, allowing you to withdraw your wealth in the future without paying a single dollar to the government. Dump your capital into broad market index funds like VU, which gives you instant automated ownership across the 500 largest, most profitable corporations in the United States, ensuring your net worth grows in tandem with global human productivity rather than depending on the erratic choices of a single political leader. If you want consistent cash flow, allocate a portion of your automated savings into a high-quality dividend growth fund like SHD, which holds an insulated portfolio of fundamentally sound companies with a long history of increasing their cash payouts to shareholders year after year. When you combine an aggressive personal savings rate with nonstop dollar cost averaging into foundational funds like VU and SHD inside a tax-sheltered Roth IRA, you create an unstoppable financial machine that makes you completely immune to whatever games the political elite choose to play behind closed doors. You do not need to check financial news when you wake up, you do not need to stress over daily chart patterns, and you do not need to worry about whether a $39 trillion debt limit gets expanded because your wealth is anchored directly to real productive human output. Building true wealth is fundamentally a psychological war against your own impulses and against a consumer capitalist system that wants to keep you broke, dependent, and trapped in a job you hate. Real financial freedom is the ultimate form of personal rebellion because it gives you absolute sovereignty over your most scarce asset, which is your time. Stop acting as the exit liquidity for institutional traders. Stop gambling in the high-stakes casino of speculative trends and start building an immovable wall of private wealth through relentless discipline, consistency, and long-term commitment. Focus entirely on your savings rate, automate your monthly investments, ignore the short-term noise of global media, and let the mathematical reality of long-term compounding do the heavy lifting for your financial future. Hit that subscribe button. Peace.